Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, August 13, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. Interesting day. We had a down day today, and of course, by now you've seen the media, the news attention that's targeted toward the currency crisis in Turkey and whatever else is going on in Turkey, and that's fine. Whatever they want to assign the reason for the down day, and I guess that was also the reason for Friday's down day as well. That's fine any way you want to look at it. If there was really a currency crisis or a crisis that was going to impact the global financial marketplace, I think the S&P would have been down more than 11 points. However, we have to have a reason. There obviously is something going on over there in Turkey. It's a bigger place from a GDP perspective than Greece, so we do have to pay somewhat attention. There is something going on. I'm not totally dismissing certain things that happen around the world that are news related and directly linked to or not linked to the financial markets. I'm not dismissing these things. I just don't like to correlate directly the news with a particular move in the market. If the S&P was down 40 or 50 handles and there was a news event tied to it, such as a financial crisis or a currency crisis in Turkey, that's different. That's more of an eye-opener. But the S&P being down 11 points, the Dow being down 125 points, which is 0.5%. The S&P is 0.4%. That's not a big enough percentage loss to say, oh no, there's a real crisis going on. And that's why I do somewhat tend to minimize certain news events when they happen, because I'm not going to just correlate directly what's going on in Turkey with the fact that the S&P was down 11 points today. But that's not all that important. What is important is that price is the absolute arbiter at the end of the day. And what we have to do is we have to determine where price is headed in the short run, and where price is likely headed in the longer run. So with that being said, let's take a look at the chart, the daily chart of the SPY, and let me dump my thoughts out. We'll unpack my thoughts a little bit, and as you know, it's a dangerous place to be, but you'll get inside my head a little bit. Before we do that, let me also take a pause and make mention that I really appreciate everybody's continued participation, posting comments underneath the video, valuable information, helpful to me, helpful to the entire community. Please keep up the great work. I really do appreciate it. In addition, hit the like button underneath the video and also share the video with those people you think that can benefit from this information. All right, so let's get back to the daily chart. So we had a down day on Friday. That's the second to the last candle from the right-hand side. We didn't do a video I didn't do a video over the weekend or Friday. So we have this down day from Friday, and now we closed right below the 20-period moving average. Could make a case that we're starting to put in somewhat of a sideways bearish consolidation pattern. So let me bring out a couple of things that I think are important. What I did was I put a line on the chart, a trend line at 279.16. Why is that important? The 279.16 happens to be the low of this breakup candle. That's item number one. It happens to be a former consolidation area. So the market over here was telling us that in and around that price zone, the market was telling us, or the chart was telling us, that that price zone was important. It happened right around here again. That price zone is important. Here again, that price zone is important. Slightly above there, but that price zone is important. So we know somewhere in that $279 area, give or take a little bit above, a little bit below, that's an important price area. What do markets like to do? Markets like to come back and test former breakout and former breakdown areas. I know you've never heard me say that before, and it might be new to most of you. However, take note of that, put it on a sticky note, because the fact that that is a fact, okay, we see it over and over and over again, we know that this was a former breakout area. And here's what I mean. Let me just draw it out so you can get a visual of what I'm saying. So the market found resistance here. The market found resistance here. The market broke out above that former resistance area. We've already been back down to retest it a couple of times. Okay, so that's already happened. We've already tested a former breakout area. Not to say we can't do it again, and it doesn't have to hold. Nothing is 100%, but we have to take it one step at a time, one tick at a time, one day at a time. So one thing at a time. So we already broke out above this area. Now we're coming back once again. The likely story is we will likely find, the probabilities say, that at least from an intraday perspective, we would likely find support in and around that $279 area, give or take something underneath and something above. That's a likely garden variety support area. If we begin closing hourly below that, number one, we have 278.29 today, and that'll move. That's the 50-period moving average. That'll also be somewhat supportive of the market. You also have a gap that exists down here. So there are definitely areas down below 278, give or take. You have a gap down at 275.5, give or take. Okay, so you have definitely safety nets underneath, not to mention, notwithstanding, the area right around 279. So if we continue to sell, there are safety nets underneath where we are in the market. Now let's look at the flip side. A couple of things that I want to make note of. So look where the official closing price, this is the 4 o'clock close today, 282.10. Why do I bring that up? Because the close is always more important than how they traded them out during the day. The low from last Friday was 282.36. So the official close was below Friday's low. That's a negative, and that tells me that price is likely, under normal market conditions, price is likely headed lower. Under normal conditions, that would be the direction that we would expect in the near term, lower. However, what's interesting is, as I make this video, right after the 4 o'clock close, the market popped back up and we're trading above Friday's low. Now, is that meaningful? Not tremendously meaningful. I don't put a lot of stock into the pre-market and the after-hours activity for a number of reasons. And my gap traders ask me this all the time, and they're good questions. Do you take into consideration where the stock was trading in the pre-market before the market opened at 8:30 in the morning, for example? Do you take into consideration where the market traded yesterday after the close? We popped up on earnings, the stock went up $10. Do you take into consideration that happened when figuring out where the likely support and resistance areas are? And the answer is, I want to know about it. Sometimes I will take it into account and sometimes I won't. That gets into a whole nother discussion that just relates to the gap trades in and of themselves. But talking about after hours activity, for example, today, I'm not holding that much stock in the fact that the market's up 30 or 40 cents after hours, because the volume is relatively light after hours. So it's easier to push a market around. That goes for individual stocks and it goes for indices, the S&P, the IWM, whatever it is. It's easy to push markets around after hours, which is why you have to take the activity, whether the market is up or down, after market closes in the afternoon or before it opens in the morning, with somewhat of a grain of salt. So there's your answer on the pre-market and post-market trading activity. Now, longer term, do we think that the market has topped out? Can we still get to and run past the old all-time highs? Now remember, we didn't do that here. The high was 286.01, but we do have an old all-time high at 286.63. Is it possible that we just peter out right in front of the old all-time highs? It's possible. It's not probable. It's possible, but not probable. So I still think we'll take a run at the old all-time highs. But remember, market's job is always to trick, trap, fool, and frustrate as many traders as investors as it can along the way. So while I do think we still have another leg higher or finishing up of this leg higher in the market. That doesn't mean that we don't have to take a leg down in order to get in a roundabout way back up to the higher prices. And that's why it may be easy to call sometimes, but it's not necessarily so easy to trade all of the time. I'm completely aware of that. That's not lost on me. So here we are, closing the day below the 20-period moving average, line in the sand, and here's the net and the spider. Line in the sand from a daily closing perspective for now is 279.16. Close below that, something else is likely brewing. As long as we continue to close each and every day above that number, then likely this is just a pullback in a continuing uptrend that, in my opinion, is not over just yet. I still think we can attain a new closing high in this market. Doesn't mean we have to stay up there for very long, but I still think we can have higher prices on not only an intraday basis, but also on a closing basis. Before we move on to other markets, there is something that I want to point out from an intraday perspective on the spider. So the reason I bring this chart up, or any intraday chart for that matter, is because I want to point out the fact that no matter what market we're looking at, what chart we're looking at, you can generally find a trade that makes sense. Sometimes it's after the fact. Sometimes we're not able to identify and recognize these trades in real time, but the more that I show you that these exist, the more likely you begin to recognize them in real time and are able to take advantage of them in real time. And here's what I'm talking about. So the market's selling off, and every time the market is selling off, and what I mean by that is we make a high, and now the market is headed downward, and we find a bottom. And what's interesting was you don't always know where the bottom is going to be. Sometimes it's a bona fide support area, and sometimes the market will just find a bottom unbeknownst to you. You'll watch it start to go higher, and then you'll wonder, is there or was there a trade at hand? And regardless of whether or not you saw this as a potential bottom or not, that's not what I'm here to point out. What I am here to point out, however, is the fact that when you put together all the things that are taught in the course at Lazy E-mini Trader, and you start to identify how these things, how these different chart patterns show up on any chart you want to look at, whether it's an intraday 10-minute chart, hourly, daily, weekly, monthly, it doesn't matter. What you'll notice is that even after the market bottomed, okay, the market went up for a specific period of time, and it went up into a specific area. And just the time that it traveled from pivot low to where it ended up making a turn isn't enough in and of itself. But the fact that it went up to a specific area, and this is something that traders that have taken the course at Lazy E-mini Trader are able to identify. When you start putting together 2 or 3 or 4 or more of these items that all line up together all at the same time, that's when your odds, that's when the probabilities of having a successful trade increase and significantly begin to lean in your favor. So yes, the market trended for a specific period of time, but when you put that together with the fact that the market went to a specific location at a specific period of time, you begin to say, yeah, now I totally understand why there was a low risk reward trade to the short side in the afternoon session that began right about here. And when you start to identify these things in real time, they don't all have to be huge trades. You line up a base hit after another base hit, after 2 or 3 or 4 base hits, then you throw in a double or a triple. You have a loser or 2 along the way, and you string together another 3, 4, 5 base hits, another double. Of course, you're going to get a home run here and there. All of a sudden, you realize that your win rate is far in excess of your losing ratio, and your winners are nice, juicy winners, and your losers, by the way, are what? Small and fast. And when you put together small and fast losers against strings of base hits and then some doubles, triples, and even home runs, that becomes a recipe for a successful trader. That's a recipe for a growing trading and investment account. that's a recipe for doing this as a living. Looking over at the IWM, we're back to the daily chart, and we have been talking about the fact that this IWM has been forming a bearish pattern. It was in no uncertain terms that we discussed the fact that until and unless this particular index on this chart was able to close above the high of that breakdown candle, this was a bearish pattern that will likely, under normal conditions, play out to the downside. It doesn't have to be an all-out collapse. It can actually be technically complete right down here around 163.5, 164. That pattern can be technically complete, but it has to at least come down there to complete or get above the high on a closing basis on this daily chart. Get above the high of this breakdown candle, 168.72, in order to take the bearish pattern off the table. We've been talking about this pattern for a few days. It seems to be materializing. So if the market's going to continue down for a couple of more days, it makes sense that we're likely to see the IWM down around 164, give or take, within the next few days. Now, here's a chart of the VIX. Now, last time we looked at the VIX, I think was a couple of 3 days ago. And what's interesting was I said at the time, whenever you get down within the 10 neighborhood in the VIX, 1050, anything with a 10 in front of it or lower, it's an opportunity to buy the VIX. At least just give yourself some time to go along with it, because we can certainly stay down there for a little while. But if you're using, for example, call options or those exchange traded products that track the VIX, the leveraged exchange traded products, they tend to have what's called slippage. So you want to give yourself some time in order to let the VIX work out for itself. Now, interestingly enough, I'm the one telling you this, and it's like the shoemaker's kid. I'm sleeping at the wheel. Don't do anything with the VIX down at 10. In fact, down here the other day on the 9th, it made a low of $10.17, and yours truly does absolutely nothing with it, and today we're up near $15 in the VIX. So shame on me, but nevertheless, if we get down to that 10 area again, the same rule applies. It just doesn't stay down there for very long, historically speaking. So maybe it goes below 10 the next time. Maybe it goes to 1050. But down with that 10 handle on it or below, you have to be thinking about slightly longer term, but buying the VIX for the risk reward. It's not going to stay down with a 10 handle on it for very long. The transports are coming off a little bit. We're still above all the moving averages, still in an uptrend, although we did come down the last couple of days with the rest of the market. That makes sense. We had a consolidation area here. That's where we've come back to. We're still above all the moving averages. So technically speaking, there's nothing wrong with this market. The daily chart of the transports is still in an uptrend. We haven't even come back down to test the 20-period moving average. If we have any more downside across this market at all over the next few days, expect the transports to come down and test at minimum of the 20-period moving average, potentially slightly lower. But from a longer-term perspective, keep in mind, there's nothing wrong with this market. When you look at the weekly chart, remember, we've been talking about the fact that we couldn't get through these old highs that came in the middle of 2018. So just a few months ago in June. So we've rallied back to those highs. We put in what I like to call a pseudo doji candle on the weekly chart. That came after the market trended for a specific period of time. Is anybody surprised? So we can at least go sideways for a while. We can sell off a little bit and let that pseudo doji candle take hold and still remain above the moving averages on the weekly chart, come down a little bit, but still remain in a relatively strong uptrend in a bullish position. So you do have both things going. I'm showing you both sides of the market. On one hand, the market is stalling out, reaching the old highs from a few months ago. And on the other hand, there's technically speaking nothing wrong with this market. We're still in an uptrend. So you can have both things happen. We can actually do some backing and filling. We can pull back a few hundred points and still remain in an uptrend and look pretty ugly on the daily chart, but have nothing really technically wrong happen on the weekly chart. Just to take it one step farther, and I don't mean to belabor the point on the transports, but just while we have the transports up and we can look at various different time frames, might as well point out the monthly chart in the transport. So we look at the daily, we look at the weekly. So you see when I try and remove some of the back and forth noise that occurs on the daily chart by looking at the weekly. Now, even so, even though we've hit some resistance on the weekly, now let's put in perspective what we see. Again, you're getting into my head again, dangerous place to be. But what we see on the monthly chart, we had a tremendous month in the month of July, a big up month. Does it make normal sense for the market to maybe pull back a little bit, maybe do somewhat of a retracement of a big up month? Would that be normal garden variety market behavior? And the answer is, yeah, from a logical perspective, that would make common sense market analysis to me. So for us to come down a few hundred points in the month of August, for example, after a huge, tremendous up month in July, isn't out of the ordinary. And guess what? From a monthly chart perspective, does that do any damage whatsoever to the uptrend that's intact on the monthly chart? And the answer is no. We're just making a bullish, sideways consolidation pattern on the long-term monthly chart. So for us to continue going back and forth is common normal market behavior. So you see how you can get different perspectives when you're looking at different charts. And depending on what type of trade or investment you're looking at, you have to look at different time frames. If I'm looking at to be in a trade for an hour or two or a day trade, that's a different chart than I'm looking to say, here's what I want to put in my retirement account. I'm not really worried about this right now. I'll check back in a year or so. Those are different trades. Those are different investments. You have to be aware of what we're looking at and why. Here we have a chart of the Qs. So the Nasdaq Composite, which is slightly different than the Qs, that was down 0.25% today. The Qs, as you can see, was up. And herein lies the reason why I always used to tell you folks that I never used to bring up the Qs chart or didn't like to bring up the Qs chart because, or I don't at least give it much credence because it's way, way too top heavy. And what I mean by that is when you take away things like Apple, Amazon, Facebook, both Google stocks, Google L and Google, G-O-O-G. So there's G-O-O-G-L is one stock, and then G-O-O-G is another. And you take away those two stocks and Netflix, I believe that's somewhere in the neighborhood of about 40%, maybe even 45% of the triple Q index. So you have like 5 or 6 tickers, 5 or 6 or 7 stocks or tickers, or a combination of both that dominate the Qs. You can see why we're flat on the Qs. We've made new highs in the Qs and we didn't make new highs in the S&P 500. And it goes to show you why I use the S&P as a much more broader index proxy for what the health of the overall stock market is. The Qs are too top heavy. Now, I'm not taking anything away from the Qs. We're still only a stone's throw away from the old all-time highs. We did close above this breakdown candle, the high of this breakdown candle. So I am looking at this as a slight pullback above the moving averages. Even if we pulled back a little more, I'm not thinking there's any damage done to this chart at all. Amazon was up another $11 today, although it was up more earlier. It's going to get tired pretty soon. It's up near $1,900. Apple at 210. It's also going to get tired pretty soon. Facebook at 180. You know, you look at these stocks and you say, you know, even Facebook from 168 to 185, that was in short order. You look at Apple, and Apple is, you know, high on the chart. It's the first $1 trillion market cap company, and I can't even get the historical data for Apple for some reason. Amazon, I don't know where that went. So Apple's chart is not coming up. There it is. So look where we are in the chart. We're at the all-time highs in Apple, consolidating. Is this going to consolidate to push higher, or is this going to fail and come all the way back down to $195 a share, $200 a share in short order, something like that? No way to tell, but the telltale signs are there. First trillion-dollar company. Netflix. Netflix is, doesn't look the same as the other charts. It's not high on the charts. We tend to be, at least it looks like it's failing, below moving averages, only above the 200-period moving average. So Netflix seems to be faltering. Google is high on the chart. Google's above all the moving averages. So you look at these stocks and you say, well, the majority of the FANG stocks, the charts are at highs or near all-time highs. It's the reason that the Qs are at all-time highs. If you take away the FANG stocks, where are the Qs? And that was really what I was leading up to. If you take away the 5 or 6 or 7 tickers that make up 45 or 40% of the Qs, where are the Qs? Do they look like something else? Do they look like, and there's always a method to the madness. Then do the Qs look something like the SMH? Do they look like a series of lower highs? A high, lower high, and a lower high. Does that chart look as healthy as the Qs look? And the answer is no, it doesn't. And so I just want to make sure that we're looking at both sides of the market. On one hand, when I tell you folks that I still think that there can be higher prices in this market, and I don't think the blow-off has finished. I don't think that we're finished with this particular bull run. That doesn't mean that I don't think we're going to have a healthy correction to follow. It doesn't mean that I don't agree with a lot of you how a lot of these stocks and the market is overvalued and there's a lot of trouble out there. There's Turkey, there's other stuff in Europe, there's North Korea, there's Iran, there's all kinds of things, there's tariff, there's trade wars. I get all that stuff. It just is only important. All those things are only important when they're important. If the market's going up, none of those things are important. When the market decides to change character and the market goes down the most of the time and the rallies are basically bear market rallies, and we're not anywhere near a market like that, but we will be at some point in time in the future. When that does occur, then those things become much bigger deals than they are now because they dominate the news, because the media will always be looking for a reason why the market was down today. So I'm not going to spend a ton of time on the SMH other than to say, wouldn't the Qs look something similar to the SMH if not for the fact that it was top heavy to the FANG stocks? And the answer is yes, it would. And so I just want to make sure that we're all aware that at some point in time, this doesn't end well, but that doesn't mean we can't ride the bull until she tells us she's done. The trend is our friend until the very end. The XBD, this is the broker-dealer index. Remember, the broker-dealer index had been making a bearish pattern below the moving averages. What's happening now? The bearish pattern is playing out to the first place that we discussed that it would play out to, which is this double bottom low. That was very, very obvious from a stopping point perspective, at least from a short-term perspective. The market would go there and it would find at least an interim level or at minimum of an intraday level of support. XBD, bearish pattern playing out. XLF, down day on Friday, down day again today, likely going to come into the convergence of the 100 period and the 50 period moving average. No surprise there. We also have a breakup candle. So there's a low of a breakup candle that comes in right around the convergence of these moving averages. Anybody tend to think we might find some support at the halfway mark in between $27 and $28, the convergence of the moving averages and the low of a breakup candle? I would think so. When I say it like that, doesn't it just make logical sense? There begins to appear more and more reasons why that price area makes sense the way I said it. Well, look, it's the low of a breakup candle. It's the halfway in between two round numbers. It's a convergence of moving averages. Yeah, we'll likely find some support in and around that number. And if it doesn't hold, then there's likely something else going on, and we're likely in the midst of a hard sell. But I would find it odd and unique market behavior if intraday we just blew through that area like it wasn't even there. That's unlikely to happen. That's how you begin to identify in real time these trade setups, to understand where price is on the daily chart, and then you hone down to the shorter time frames to affect your intraday charts, your intraday trades, and then you trade off of an intraday chart, an intraday pattern based on the price action, the money flow, all that stuff. And that's how we begin to put together everything that's taught in the course at lazyminitrader.com. That's the way it works. That's the whole point. How about gold? We talked about gold going to 1200. I couldn't do anything other than jump up on the table and say gold is going to go to 1200. The problem is you never know whether it was going to stop a few dollars short and have a rip-roaring reversal and rip the face off the shorts. That happens all the time. Or was it going to blow through and go to 12 or 1185 or some number below 1200 for those that are thinking that they can buy it at 1200 and get their face ripped off. And we kept talking about it. I mentioned it a couple of times. The reality is it just kept dripping lower. This was in a perpetual downtrend. There was nothing good in gold. We don't need this trend line anymore. There's just nothing we can do with this chart until and unless we see the signs and a signal of a reversal. Just be a spectator. I'm an umpire calling balls and strikes. Nothing to do with this chart whatsoever. Crude oil in and around 66.80 seems to be important to the market. Closing below that will bring lower prices, and the first place we would go to would be where? The low of this breakup candle, 64.79. Call it 65, give or take. Probably spike through 65 down to 64.85, something like that. That's where you're likely to find some support from an intraday perspective. Right now, we seem to be making a bearish consolidation pattern. You see we're trading in and around these moving averages. We've been back and forth through them so many times. It diminishes the importance of these moving averages. So I'm not going to give them too much weight or too much credence. But what you can see here is until and unless we can get above the high of this breakdown candle, 69.37, that would be bullish, but we would have to close above there on the daily chart. And until we can do that, or unless we can do that, then likely story is this will form a bearish pattern and will likely finish off to the downside somewhere in the neighborhood of $65 a barrel, or potentially lower, but that's the first target on the downside if this bearish pattern is going to play out. And folks, with that, I am definitely out of wind. You heard my voice crack a couple of times. It's everything I wanted to and intended to discuss tonight, so I will give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.